Today, I'm gonna make a presentation on a very classic paper written by Stein. The title of this paper is Prices and Trading Volume in the Housing Market, a Model with Down Payment Effects. Let's get started. The motivation of this paper is actually on the fluctuations of the housing prices in the US, as illustrated by the following figure. This figure contains the information on the home prices in a sample of the US cities, including Boston, LA, Miami, and Phoenix, from 1983 to 2014, where the vertical axis refers to the home price index and the year 1983 is the base year. The trend is pretty obvious from this graph. We can see that the home price has fluctuated substantially over the past 4 decades for these four representative cities in the US. And a natural research question is, what accounts for the fluctuations in house prices as well as trading activities? Well, with regards to the previous literature, in terms of the house prices, one strand of the literature is the efficient market literature, where some papers suggest that house prices depend only on current and future fundamentals. And a very key challenge to this strand, the efficient market literature, is that it's very hard to reconcile the boom to bust episodes in reality within the model in this literature. And the second strand of the literature, the expectation literature on the trading activities. The researchers argue that sellers in their model adapt their expectations very slowly. That's why when the housing price when the housing price declines, the sellers do not cut their prices to the appropriate levels. And the third strand of the literature um, analyzes the interaction between the down payment requirements and the consumption savings choice. Basically, they find that the down payment requirement in the life cycle model distorts the consumption downward. And here comes the model setup. There are basically three periods in this model. The 0, 1, and 2. And also there is a continuum of families. And t equals 0. Each family, they have a house as well as a debt, k, in this interval, where the minimum KL can be positive, meaning that each family can actually have can be negative, sorry, meaning that each family can have positive assets. And t equals 1, each family start to trade houses. And it's worth mentioning that in this paper, no new homes are built. And there are three following key assumptions. The first assumption is that a family must repay the debt if they want to resell the whole house. The second assumption is that if the family want to buy a new house, they must pay a required down payment, where the gamma refers to the minimum down payment rate. The third assumption is that there is no rental market. And then in the last period, at t equals 2, each family gets a utility from three components: food, the size of the house they live in, and whether they live in a new house. And let's go to the benchmark analysis. When gamma equals 0, meaning that the down payment rate is 0. and thus no down payment requirement. Since each family gets utility from living in a new house and t equals 1, each family, they will trade on house, which is very intuitive and uninteresting. So let's turn to a more interesting case where gamma is positive. Basically, under this scenario, there can be three potential families. The first family, we call them unconstrained movers. They refer to the group of families whose behavior is not constrained by the debt. So what they are going to do at t equals 1 is very simple, because they are not constrained by the debt, and they also get utility by living in a new house. What they will do is to sell old houses and buy new units of houses at time at t equals 1. And the second family, we call them constraint movers. They refer to the group of families who prefer to move to a smaller house despite the funding constraint. Their optimal choice is to move to a smaller house until the breakpoint, K star, where the utility of moving equals the utility of not moving. And the third family, we call them non-movers. They refer to the group of families who have the highest level of debt. Since they have the highest level of debt and there is the down payment requirement, their optimal choice is to remain in their old houses. And if we extend the analysis further, where under the assumption that there is the down payment requirement, in the market, we only have the unconstrained movers. Actually, we are back to the gamma equals 0 case, where there is no down payment requirement. The reason is very simple, because even though the down payment is required, the market exists only the unconstrained movers. They are not constrained by their debt, and they get utility by living in a new house. So, at t equals 1, all these movers will trade on a new house, and then buy a new house. And if the market also exists some constrained move investors apart from the unconstrained movers, the demand for the houses actually increases as prices rise, because as the house price increases, the liquidity constraint for this constrained investors are actually relaxed, meaning this term P, the price of their home when they sell their new house minus their debt after they pay their debt becomes higher, meaning that they have more funding net of the debt to pay the down payment and then buy the new house. So in the final case, we start to endogenize the down payment requirement, where we add the role of defaulters. They refer to the family who have no income and no ability to repay the loan. And t equals 0, these defaulters, they have a house consistent with the assumption in this model, and they have no debt. And t equals 1, there are two choices left for these defaulters. They either consume their house or they move to a new house. Well, actually, the new houses are cheap for these defaulters, since they can always borrow to buy a new house and then choose to default. And there are two mechanisms to screen out these defaulters. First, the market can increase the down payment rate. In addition, we can also impose a penalty on these defaulters, such as social stigma. And this concludes my presentation.